Welcome back, everyone. In this next session, How to Trade the News, our experts will help you tell the difference between economic events and the market's expectations that move asset prices. Adam Button, Chief Currency Analyst at ForexLive, will moderate this session and introduce us to his esteemed panelists. Adam, the stage is yours.
Okay, thanks so much for having me here. Wonderful panel here, and it's an interesting time in South Africa. We're going to talk about local news, we'll talk about world news, and really how to think about news. But I'd like my panelists first, a quick introduction of themselves and what made you fall in love with markets, or what sort of events got you thinking about markets and how to make money with events changing in the world and in the changing world. Go ahead, Jimmy.
Good morning. It's still good morning in some parts of the world. My name is Jimmy Moyaha from Lebowa Capital, and it was an accidental journey stepping into markets. I had come out of mining and found myself accidentally in the service space within financial markets. And since then, it's been year after year of falling in love with different dynamics within the markets. I've gone from retail trading and retail understandings to institutional markets, to asset management, to alternative assets. And it's been a very interesting journey that I'm still on. And I think I'm still falling in love with the markets the more I stay in the space.
Well, good afternoon, everybody. So my name is François. I represent HFM here today. And my whole thing behind falling in love with the markets was, as I started, I kind of realized, very similar to trading news, that every single day is something different. And regardless of what I do on a daily basis, you never really lose that excitement of having a different approach on a daily basis. And that is something that I could find in no other profession.
Hi, I'm Fraser Nelson. I'm representing DoPrime. I'm our head of our institutional offering now. How I fell into the markets, I was 21. I got offered a job in the States working for PDVSA. I was given a 1 billion oil portfolio a month, and I like to gamble. And that's how it was. And I learned over time it's not about profit, it's about risk management, sensible trading. After the 2008 crash, I started to see oil companies and shipping companies I worked with transitioning into the CFD market. And I developed an interest and quite an affinity and a love for it, and I've been growing ever since.
That's great. We talk about news, and a lot of traders like to avoid news. They just look at a chart and think that can tell the whole story. We do the opposite at ForexLive, where we're talking about live news and live changes and everything that moves the market and why. And there isn't always an answer for what moves the market. But how do you, what perspective have you gained on that, Jimmy, and what, how you think about the technicals, the fundamentals, and what's really moving markets?
It's funny that you use that example around not having an answer, because similar to what Fraser mentioned around the economic events that happen, I immediately went to a specific time in 2017, 18, 19, where the markets weren't moved by fundamental or by technical analysis or anything. They were moved by a gentleman named Donald J. Trump and his Twitter account. And explaining that, I think I never thought living in financial markets you'd live in a time where that is what happens, where the president of the United States tweets something and the market goes crazy. So it's definitely been a learning curve where you start to see, depending on what type of news and what type of information you're looking for, you know where to go for that information and how to process that information. And I think that becomes so much more important the longer you stay in the game. And I mean, I'm sure Fraser will attest to this and same with François, when you started in the markets, the information you looked at from a fundamental and a news perspective 5, 6, 7 years ago, you probably don't even look at today. And that's not because the information is irrelevant. It just means from your portfolio and why you're looking at that news, it's not as a significant data point as what you want it to be. At the same time, there are data points that come out like the personal consumption expenditure numbers in the US that have a material impact on what's happening because it's a preferred measure from the Fed in the US on how they measure things. So news becomes the cornerstone of how you build on what you do. And as it relates to what you mentioned around news versus technical and the age-old debate about whether fundamental analysis or technical analysis is better. The reality is fundamental news and fundamental information drives the decisions that are being made at an institutional level. Price action follows secondary to the announcement that was made. It might follow years later, it might follow weeks later, it might even follow minutes later, but it does not happen without something driving that. And I think a lot of us, a lot of traders, at least when I started in this space, a lot of traders thought that, oh, if I set my price at this particular price action, the market will move there because that's what price action does. But you're not understanding why price action responds the way it responds. And the journey you go through from a retail trader to an institutional, understanding liquidity, to now looking at portfolio management for a 5-year, 10-year portfolio, it's a remarkable journey.
That's great. That's great insight. One of the things you picked up on is the changes, and you're an educator as well, and a lot of fundamental analysis or a lot of news, you know, what I might have taught 10 years ago, it's totally different right now, or what mattered then doesn't matter now. And like inflation is a good example. For 10 years, the inflation numbers never mattered at all. And then when I started into trading, you could just trade good news as good news. You know, non-farm payrolls would come out 20 years ago, and you could just hit the button and buy, or you could sell bond futures and make money. And that all the mentors I had, that's what they did, and they did very, very well. And then the algos got in, and it changed. And now one of the things, you know, we were talking about, Fraser, was a lot of times with news, when you want to trade something, the liquidity disappears, right? And when you need to get into the market the most, that's when the market sort of disappears on you and you're paying wide spreads. And, you know, what are things that people can do to deal with that?
100% on that. You know, from our perspective, and it's something that when I joined the company 2 years ago, it was our primary objective. We were an APAC-based company. We've grown organically because of the liquidity and because we were solving those problems. The way I look at it is liquidity is like painting a fence. You can do it all the same color or you can do it in different colors, and each region requires that. So for Asia, we very much price from Mitsubishi, Tokyo FX. We then have pricing in the Middle East, we have pricing in Europe, and we have pricing in the US. So we're making sure we can offer that continuity of liquidity to our clients, but more importantly, the continuity of depth. This is obviously the problem. Whether you're speaking with PBs or POPs these days, the constant conversation is NOP limits, maximization, and this is where it is. And to go back to one of the points Jimmy mentioned before on fundamentals, we're looking at assets where you're seeing a lot more priced in movement now because of the algos. So where traditionally on something like the NFP, we would see 110 to 130 pip movement, we're now seeing a 65 to 70, and we're seeing a very quick jump. So a lot of traders are jumping in, trying to get that trend, and are actually hitting the top point. So there's not one or the other answer, it's always a mixture. And to go on about the fundamentals and Donald Trump, which to me, when that happened, it was a big change in the market. But if you look at even something like stocks, for example, which I know we all probably started in and looking at, you just have to look at Reddit and the AMC situation from last year. But not just last year. Now, in the last month, you have companies like Barstool and on all their podcasts talking about it. You have Logan Paul and KSI on there. And this is where you get a 100% jump. The P&E ratios, the actual technicals are atrocious. But sentiment drives the market. People's buy orders. But what people need to understand is there's a difference between stocks doing it and there's a difference between gold and currencies. Because in stocks, a very small player or a group of small players can drive the market with their orders. But when you're looking at oil, gold, and currencies, you're at the beckoning of the big boys. So sometimes you have to ride the coattails opposed to trying to push the coattails.
Yeah, that's a great point. We were talking about like how to get an edge in news, and you guys brought up Trump a few times, and I spent 4 years covering every tweet, and it was just impossible to figure out what he was doing next. And sometimes you have to give up on that, but other times you can get an edge in the news. You know, and sometimes it's with sentiment. That's an interesting topic. François, how do you think about trying to get an edge from the news, or thinking about, you know, what can happen in the news versus reacting and acting on the news or anticipating the news?
So personally, as a discussion we had a little bit earlier, for me, it's not about anticipating what news does. It's more about reacting on data that is being released because that is factual. That is something that's a tangible figure that I can actually use and then use for my trading from there on forward. And within, as Jimmy stated earlier as well, things we used to look at in the very beginning is not necessarily things we look at right now anymore. Because the fact that when I started out as a trader, I remember my economic calendar was like my Bible. It's what I looked at every single day. You wanted to know what news event is being released today. Now it's not the case anymore. So for me now, it's more of the entire psychological point behind what that news is going to do for the next week, for the next month, for the next 6 months. And as we discussed a little bit earlier as well, it's what we've seen happen this year with currencies as well. I mean, in December, we saw a massive rally within the market, within stocks, within currencies. Why? Because of the fact that there was that entire market sentiment shift that during this year we had a certain anticipation for the amount of interest rate cuts that the Federal Reserve would release during this year. As the year started, we found out that, well, this is not going to happen. That market sentiment now shifted. However, as a trader, reacting to that sentiment within December, January, February, you could actually capitalize on that bullish movement, on that rally that took place. And now, as that sentiment shifted, again, now you can have longer term trades and trading the news. And what traders also need to understand, it is not just always capitalizing on that initial 5-minute spike. If you understand the entire sentiment behind what news can do for your trading, you can have a much longer term approach, and it can literally guide you and give you your trading decisions for a very, very long time.
You know, I think that's interesting. You get those turning points sometimes from news and news events. We go back just 2 weeks ago, the FOMC, which was a little bit dovish, and then non-farm payrolls, which was weak for the first time really this year. And since then, it's just been one-way traffic in risk assets. And you know, initially, yeah, there's that 5-minute move, but there was really a 2-week move that's still going on the heels of that. But let's try to illustrate, you know, what happens in news or what traders, how they think about news. So South Africa's having an election next week. Am I getting mixed up? And you know, how are you thinking about that, Jimmy? And you know, what scenarios could unfold? You know, I think back to, you know, that U.S. election, the presidential election, trading that. They're some of my most memorable events as a trader is watching those numbers come in, seeing the market react to it. And I remember Brexit, everybody had it wrong because London came in first and they were all voting Remain. And you could see, though, we had a model of every district in the UK, and they were all underperforming. And then as the rural districts came in, you could start to see the tide shift, and the pound fell, you know, 10 full figures. So how are you thinking, you know, this is a big election coming up here, and what are the scenarios in your mind, just to illustrate quickly how you're thinking about the news and how it might change the state of play here?
So perhaps let me give a bit of context around the South African picture, right? So I'll go back to a fateful December, Friday, I think it was December 5th, 2015, was the day that we reshuffled a finance minister over a weekend. And Fraser might know this because at the time, what happened was there was an algorithm in the US, markets were closed in South Africa, and the Rand absolutely lost, I think, 20 to 30% in probably a space of 10 minutes to an hour. And Monday, markets obviously self-corrected, other players came in, Asian session came in, South African session came in, and all of that. But it points out a very important point around the South African picture. The South African Rand is a politically sensitive currency. And we're in our biggest election ever. 30 years into democracy, the first time the ruling party, or governing party, sorry, they don't use the term ruling, the governing party stands to lose its majority, stands to lose more than 50%, or stands to go below 50% of the vote. What that means is, from a news point of view, this could be a tipping point in how we fundamentally see South African data going forward. François and I had an offline discussion around the data points that you look at in South Africa, right? And you and I spoke about this as well, Adam, to say there used to be a time where you would look at the unemployment rate in South Africa. Now unemployment is at 32.9%. It's not even a factor. We're only really concerned if it comes below 30%. News is shifting in the South African landscape, especially around how the international markets then see South Africa from a risk perspective. So when international markets and other sessions look at South Africa, the fundamentals they're looking at is what is your economic policy? What is your fiscal policy? Where do you stand on dealing with the grey listing that we're on the grey list with the Financial Action Task Force? How are you dealing with that? Are you going to come off by 2025? Is a new government regime going to revamp the entire fiscal structure of South Africa? We've just approved the National Health Insurance Bill. Those are all fundamental news. They've got nothing to do with the price.
What are the answers to those questions? What does it mean for the rand? I mean, and I think about election night itself as well. You know, how do you trade it? And you know, just to touch on that quickly, and then on the liquidity that might be there or might not be there on a Wednesday night election.
I mean, just to follow up on what Jimmy's saying there, I mean, you're not just looking at it in the fact of the stability of the point. I mean, you're looking at it at the point of you have potential political parties which are going to come in and shake the country in very different directions. You could have the DA, for example, could take a majority, and it could change. And from the sentiment I'm seeing, there's very high price points on that. But then you could also see the EFF and MK take a large part, where you're talking about land distribution, nationalization of industries. And I know from a lot of commodity traders myself, you're looking at platinum and gold, and I've seen quoted very high figures in the 26s, 27s, and 28s. You're talking about a mini recession because you can dry up 20 or 30% of the supply in one day. And that's the problem. And if you have people with uncertain choices and uncertain directions, it creates uncertainty, and people would rather jack the prices high now than risk it hitting 3,000 or 3,200. We don't have to worry about the deliverable markets. It's the futures markets that panic, because you're talking about big traders with billions of dollars of portfolios buying on 30, 60, and 90-day deliverables. So they're looking at what's happening in the future. So they don't care about today's price. They care about what it's going to be in 2 months and 3 months, because that can hurt their bottom line by hundreds of millions of dollars.
And so I like the point that you bring up, Fraser, because as a trader who's sort of transitioned from your entry-level trading, and François can attest to this as well, there's certain things that you look for in news when you are a retail trader, and that news lines up with your retail strategy. When you get to the point when you are an asset manager and you're managing client portfolios and you're dealing with the liquidity or not the outlook that Fraser alluded to, your exposure and your understanding of news fundamentally changes. I now no longer care about what a price chart is going to do on a daily, on a weekly, on a monthly. Monthlies are where I'm looking. If I could get a yearly chart of data, I'd love that on certain instruments. Certain instruments, you don't get data that far out. Now, the reason we're looking at that kind of large scale is because when you step into long-term strategy thinking, the news that you look at is from a long-term perspective. You're not looking at what today's NFP is going to mean. You're looking at the last 6 NFP readings, trying to project the next 6 NFP readings, trying to understand how that marries with the PCE data, how that marries with the previous FOMC minutes, because there's a confluence of information that comes out at different times. And when you are looking at, if you're trading the NASDAQ 100 as a retail trader on a Friday and NFP comes out, there is a lot of excitement around that. You do that. It's a 5 to 10 minute thing. It's very short-lived. When you're managing a 3 billion rand portfolio, a $10 billion portfolio, it doesn't matter the size of the portfolio, but when you're managing a portfolio on a long-term basis, the decisions that you're looking for in the news are fundamentally different from the decisions you look for as a retail trader. And what Fraser alluded to around that is, if you can start to see news from that level, it informs better decision making when you drill down to granular levels.
Building on that as well, so adding to the election part of what is happening currently within the country, so looking at that from my perspective as a currency trader now as well, and trying to understand the larger sentiment behind what this election could mean for us. I mean, we have seen within just our last few weeks how, as Jimmy stated, this is the first time that the main party could actually go below 50%. That is creating, from a fundamental point of view, now we're creating a sense of uncertainty. Uncertainty leads to fear. And we have seen companies now leaving South Africa just because of that uncertainty. And that also leads to additional investments leaving the country, which again affects the value of the currency. So as a trader now, again, I'm looking and I'm sitting, analyzing from that perspective, what is this going to mean going forward? Because it's always that part of, I would rather trade what I know than what I don't know. And at this point in stage, let's say we get a new ruling party that comes in. Let's say there is a fundamental shift after the election that creates a level of uncertainty. We don't know what that will mean for any fiscal policies, any monetary policies going forward on that. So that can again lead to that additional fear within the market, which ultimately, as we stated, the rand is an extremely sensitive currency towards that, which could lead to either a much weaker rand or some strength coming into the market. So again, we'll just have to wait and basically, again, from my perspective, react on what happens.
And like just to go on, like just to take it out of the South African picture, for example, because we're discussing current events, but we don't know what's going to happen. A prime example is the euro against Norwegian krona. Okay, so pre the Russian invasion of Ukraine, in 13 of the previous 15 years, the Norwegian krona in late March to early April has raised between 4.5 to 6% every single year. Why? Because the government of Norway, sorry, the NOK, not SEK, literally has auctions for its oil. So it sells off new plots, which means more income for the government. So every year it's risen. Suddenly, Russia invades Ukraine and all balls are off the table. This is what happens. It creates uncertainty. 1 year of uncertainty, you think, okay, maybe it'll go back. A second year of uncertainty, okay, maybe it'll go back. And it hasn't happened again this year. So that trend has now vanished. So this is how it happens. You can have as much confidence in your strategy as you want. But if the world is changing and the dynamics are changing and you don't change, it's like the dinosaurs. You're just gone.
It's true. We write about seasonals a lot, and seasonals are one of those things that you would think shouldn't work in an efficient market, but they do over and over again, and you just need to look out for those game changers. But it is interesting what you said, Jimmy, about institutional not being too worried about the news, and that's true until there is a real game changer in the market, and these sort of people who aren't watching, sometimes then they tune in, and that's when you get that real panic in the market, and it's levels. Events that are like COVID level or major elections or some massive change in the world. And I think there's an opportunity for retail there. And in general, in elections and in news, fading fear is, I think, the strategy that works. It is the most powerful emotion. And retail traders can get an edge if they sit in there and think, listen, I don't think the world is going to end at this next election. And in general, you see a bit of a relief rally on any election result in any country now. It always seems different, right? We're talking about so that this is a different election. And so that is that same sort of feeling that you have around every election. This is going to be, it'll change everything. But then the next morning the sun comes up and people go to work and you think, well, it's uncertain, but we didn't elect like maniacs here, right? So things tend to get better. And I think there's a real opportunity there. What other edges do you guys see in trading the news or thinking about the news? You talked about sentiment, and I'd like to hear a little bit more about where you gauge that. A lot of what I'm trying to do is thinking, wow, everybody's freaking out about this now. So now maybe it's time to take the other side, or everyone's excited about this. How can you evaluate that?
So something François said, and we've sort of been circling around this thing, and I'll use the South African rand as an example because it's a very easy example to understand for most South Africans, is there's reports that come out on a quarterly basis, on an annual basis, that say that the rand is undervalued. It's one of the most undervalued currencies in the world and probably the most undervalued emerging market currency. And we've been skating around this whole thing of how the news impacts things and all of that. So there's a key concept when looking at the rand that will hopefully clarify a lot of this, and it's called the risk premium. The currency risk premium. That is effectively what Fraser said, what François said. It's international markets and other participants saying, how much of that risk am I willing to tolerate on that particular, it typically happens in the rand. We do see it in some of the stocks and other markets as well. But this risk premium concept is where you should be looking if you're looking to see where the institutional money is sitting. Institutional money prices in a certain level of risk. Something François said about waiting for the news to drop and not front running the news is very much the best strategy you can use as a retail investor, because anticipating something that hasn't happened doesn't mean it's going to happen the way you anticipate it. But at the same time, if you're looking at how the institutional guys manage their books, manage their flow, manage their portfolios, they price in that premium. They price in, Fraser said it earlier, platinum price is back above $1,000 at the moment for the entire year, and I think probably from about October of last year, it struggled to break beyond $975, and now for the first time we're above 1,000 because the institutional money that actually moves the market at that scale is saying this could potentially be a risky event. Let's price in some of that risk. We're not going to be able to price in all of the risk, but understanding what the role of a risk premium is at a macro level can actually help you get a gauge of saying, okay, have we priced in too much risk? Which is what we did at the end of the year, right? So François said we came into this year expecting we're going to get 7 rate cuts. Now we're hopeful if we get half a rate cut from the US Fed at this point, right? And that pricing in took place to say, okay, if we're going to get 7 rate cuts, that means markets will likely perform in this manner, and therefore this is where we sit. By March, the markets were like, this is not happening, a correction is needed. That correction didn't happen because the market suddenly found out new information. It's because there was a risk premium that was priced in that didn't pan out at the scale that was priced in, and markets need to adjust.
Okay. Any thoughts on edges in markets or what you're thinking about in terms of markets right now? You know, I think it's very much a data-driven market. Every single news event that comes in, and the way I trade it or evaluate it is I have a view. I have a view that inflation is coming down, and that is this going to validate that view, or do I need to manage risk around that because nobody knows the future? You know, how do you position with that sort of thinking in mind, or how would you advise people to look at that and evaluate that?
Well, very true in what you said with regards to there is so much data available nowadays. Okay, it's not, as I discussed yesterday as well, it's not that I have different news that Jimmy reads. We all have access to the exact same data now. So for me, the only way to actually get that edge is to actually try and understand and develop that understanding behind how do we interpret news now. Because the fact that if you get better at anticipating how larger money, how the institutions actually interpret different news events and different findings within the market, that will be able to drive your trades better. That will be able to allow you to position yourself better as a trader, because now you're taking that data that we all have access to, but you are trying to understand and getting better at understanding the mindset behind how our emotions, how that emotion driven, because at the end of the day, we're still people pushing buttons. Okay, we only have 2 options. So it's not that we can do much more than that, but what my emotion behind that pushing that either red or blue button is. And if we can get that edge within the market, that literally just scales your trading to a whole new level.
Go ahead.
Now for data, we're all talking about it. Access to data has become so much easier over time. When I started out 20 years ago, I would spend easily 10 hours of my day was just researching, looking at ticker tape and numbers, looking at orders, going through my Bloomberg terminal, seeing who's holding. I'll be very honest, I probably do 15 minutes a day now, and I use an AI tool. And I just ask it a little question, and it scrapes the internet for me and gives me it in a 15-minute period. Now, does it give me everything? No, of course not. So I still have to pay for certain things. I still utilize my network and people that I know who's looking at what, where are we priced in. But for me, the key point is you need to focus in on the asset and build out. If you like to trade gold, fantastic, trade gold. Learn everything about gold. Spend all your time looking at gold. But then don't go and do the euro-US dollar. Yes, there's a correlation there, but look for assets that are directly correlated. Look for stocks, companies that are trading heavily in gold, jewelry companies. Because then when you're focusing on one thing, you can divert 10 or 15% of your portfolio to these, and these things are correlated. What most people do is they drown in the data. They don't know what they're looking at, and it starts to confuse them. My standard advice, and most brokers don't like to say it, but if you don't know, don't trade. It's as simple as that. If you don't know, don't click the button. Because what you're doing is you're gambling. And if that's what you want to do, take your money, go to a casino, because at least you'll get a free drink. And that's the truth of it.
That's very well said. We're happy to take some questions if anyone has a question. Oh, we have 2 hands quickly up. Somebody will come around with a microphone maybe in a moment. But yeah, I really love those ideas.
Hi guys, thank you so much for just coming over here and talking about how to trade the news. Something that I'm very interested in. Just recently I've been back testing just how the market reacts to news exactly when they come out, so looking at the 1 minute, 15-minute time frame. And I'm now shook to hear that you guys don't even look at that as institutional traders. So I just wanted to understand, how do you guys look at the news, and how can a retail trader learn how to look at the news in the same way that you do?
Could I be boring from an institutional standpoint?
I was
first?
just going to say, tell them about order blocks. Go for it.
Yeah, I won't bore you too much with the order blocks and book formation and decal lines and all this kind of stuff. But I'll be very honest with you. What we're doing is we're pricing in the movement anyway. We know where we roughly are. We watch the buy orders from other companies, and we're seeing, right, this is what the expectation should be. This is what, and I'll be honest, from a personal standpoint, I usually look for the first 30 minutes before an event and the first 10 minutes of an event. That, for me, is how I see where the pricing is going, because nobody wants to jump too early. You jump too early, you lose 1-2 pips. For a trader, it's only a couple of dollars or $100. For the big boys, it can be thousands and tens of thousands and millions. So it's important on the timing. But for me, how I do it is I'm using limit buys and limit sells. I don't care about missing now. I care about the next jump. So for me, I look where the next breakout points are on both sides, and I go below them and above them. And if we have a breakout by let's say a 10% margin on either side, then my limit orders go in and then I take advantage. I would rather only make 30 pips on a position than lose 90 pips because I'm jumping too late or I can't find the liquidity.
Absolutely. And just so Adam actually stated earlier that he listened to my discussion yesterday on that as well. And I love what you said about limit orders, because so many traders are, from a retail perspective, scared to actually talk about them, because again, now we get the topic that comes on, but if I use a limit order, I'm going to have slippage and I'm going to have this and I'm going to have that. But you as the trader, from a retail perspective, you need to factor that in. Okay, we also need to understand that slippage is unavoidable, especially if you actually want to go and trade that 1 minute prior to a CPI release. However, if you don't over leverage your account, if you place your orders at a safe distance from where you are currently, you will be able to capitalize on certain movements. Because, and that's why I stated yesterday as well, for me, if I do enter that specific event, I will place that limit order up to 15 minutes before the news event even comes out, because I have those set levels, we have our order blocks in place, we have all of those key aspects to our availability to mitigate that risk. And if you are then wrong, the market spikes in an opposite direction and you are not in a trade. And that gets me back to that point where I'm protecting my capital at all times. And from that perspective, you can then manage your risk better.
I think something retail traders are afraid to do is there's a sense of FOMO. If I don't get in when the news drops, I'm going to miss the move. When you are looking at a market and your decision is not driven by an immediate move, something Fraser alluded to is a birthing period, where prior to the news and after the news, markets will move. There's volatility, then markets will settle. But when they settle, they've decided on a directional movement. They've decided where they're going to go.
Right. Real money never comes in till the next day. It doesn't.
And this is the thing, right? As a retail trader, we're so, and I went through this as well, you're so fixed on saying, I have to hit the move. And for me, I think it came from being somewhat of a perfectionist. I have to hit the move at the right entry point with the right stop distance that minimizes the exact amount of movement so that I can get the outcome. The reality is that's not how markets work. Markets will go through indecision. Markets will go sweep liquidity at a certain point. You'll find a price sitting in the middle of nowhere. It'll go sweep liquidity at the bottom, sweep liquidity at the top, and then move. And as a retail trader, you're like, oh, they're stop loss hunting me. It's Joe's fault. Sorry, Joe, I'm looking at you. It's Joe's fault. He's moving around. He's stop loss hunting me. It has nothing to do with Joe. He doesn't even know where your order is. The market and understanding how liquidity prices into the market is making that decision. It has nothing to do with us, right? So when you're looking at trading the news, your 1 minute and those smaller time frames probably shouldn't be where you're pricing in for a big move. If there's a big move, there'll be volatility, the market will settle, then the market starts the actual move. And that's the move you want to get in on. That's the 30 pips or the 60 pips or the 100 pips that Fraser is alluding to. You don't care about the volatility. You want to be in it for the long run because your capital is protected if you ignore the noise.
All right. That's all the time we have for today. I'd love to talk more about the news, and I do think there are opportunities on those short-term charts. And I'll be over at our booth, and I'm sure you'll find these guys around here. So thanks so much for joining us, and look forward to talking with a few more of you later.